Hey there, everyone. Dave Keller here with Market Misbehavior, and this is our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, learn about their investing journey, understand the tools and techniques that they use to understand the current market environments, and then talk about market conditions today. Talk about a unique investing journey. Today's guest is Vibha Jha. Vibha, in her former life, was an executive at a large health insurance corporation in New England. Then she taught herself how to invest. She was so good at it, she ended up being at the top of the leaderboard of the U.S. Investing Championship 3 different years. We'll talk about that journey, how she taught herself to invest, what tools and techniques she's used to have previous success, and how she's applying those lessons learned to the markets today. So please enjoy this really interesting conversation with corporate executive turned champion trader, Vibha Jha. I am super excited to welcome Vibha Jha to the show today. Vibha, a corporate executive turned champion trader. Vibha, I've followed your work. I've seen interviews before, and I'm so excited you're giving us some time and for our viewers today. So welcome to the show.
Thank you so much. I'm so happy to be here.
So you have a unique background. I love to ask new guests about their background, how they sort of got from where they were to where they are now. You have that rare, I think, successful transition from being a corporate executive to being a trader with some great success. Can you talk a little bit about that transition, your background as a healthcare executive, and how you kind of got to this point? Was that a logical transition, an easy transition, a surprise? Talk to us about your journey to get you to this point.
Yeah. So, if some people may already be familiar with my background, but, I didn't grow up in an investing family. So, when I started working at Aetna, I was mainly investing in savings bonds and money markets, CDs, whatever. But one of my brothers got a job at Goldman Sachs, and this was in the mid 90s. And the whole time when I was in savings bonds and CDs, he was telling me, come on, Viva, buy Microsoft, buy Cisco, buy all of these, companies that have a lot of potential. And I said, I'm not going to do that. And then in 1999, when I was home on maternity leave, I was looking at all of these big stocks I missed. And I said, oh, he's onto something. Let me get in. So I got in December 1999,
Oh,
and
no.
I proceeded to lose 70 to 80% of my money. And over between that time and between 2002. So it took a few years to get there, but I realized that there's so much potential in investing and trading, but I had no idea what I was doing. And in the meantime, I was working at Aetna. I had a bunch of different roles, starting out with financial underwriting. So I was always good with the numbers, with risk management, with, looking for patterns and trends. And, but I didn't necessarily want to do that my whole life. So I set a goal at that time. I clearly remember it was 2003. And I said, my goal is to be retired in the next 10 years. And I'm going to do my best to grow my career as much as possible. I was 110% committed to my career, as well as with my family too.
Right.
But I said, I'm going to learn how to do this. And so my journey actually started with first making that commitment to learn. And my first inspiration was Peter Lynch, who, as a Fidelity guy, I'm sure I actually had the honor to meet him in person a few weeks ago at a Fidelity event. And again,
Cool.
Amazing person. But his message was very clear that you don't need to be a Wall Street professional to become successful. And so I was very much inspired by him. And then it became kind of trial and error, experimenting with different things. Initially, I was just all about fundamentals, but clearly I bought a very strong, when I bought Microsoft and Cisco, they were still strong companies, and they weren't like the dot-coms with no earnings and sales. They had all of that. They had, unique products and institutional sponsorship, but I bought them at the wrong time. And so it kind of became a journey for me, starting with the fundamentals. Then I started paying attention to valuations using value line, not so much PE ratios, but more just in general, like, okay, this is what the market cap is. These are the sales and earnings. Like, how much runway do they really have?
Yeah.
And then my corporate career helped me with that, because in one of my final roles, I ran a business unit. I ran profit and loss for what we called our middle market key accounts business, which brought in revenue of $4 billion to Aetna by the time I left that role. So it was not a little unit, it was a big
Yeah.
unit.
Yeah.
But I was exposed to middle market, we call them plan sponsors. So basically employers that had between 300 and 3,000 employees who were interested in getting a proposal from Aetna on offering benefits to their employees, healthcare benefits. So I learned a lot about these middle market sized employers, and many times when they came to us, it's because they were growing, or they wanted to get another proposal because their business was changing. So
Yeah.
I got a lot of ideas just from researching these companies, because when we used to meet with clients, of course I would go to their website and learn about them and try to understand what their approach was and what their business strategy was. And so when I started really investing in individual stocks, I looked at them as businesses that I would
Mm.
potentially want to own, not just as a ticker. And that's why I spent so much time on the fundamentals, because I wanted there to be a story and I wanted there to be something that would last for more than a quarter. And
Mm.
part of that also came from my background in running the P&L, because, we had 3-year business plans, we had 5-year strategies, but, if anyone tells you that they can predict what's going to happen 3 years or 5 years from now, I don't know how much that they actually are able to do that. So I very quickly realized that, yeah, having a strategy is important,
Mm.
but you can't just rely on the strategy, because there's so much that's going to change. So I
Yeah.
really tried to then drill down into, okay, strategy is important, but to really execute and make money, that's when I started to understand I have to understand the technical aspect too, because I can't just rely on what they say in the earnings or what their outlook is. I need to really understand how is the market responding to that,
Mm.
and learning technicals was the best way. And that was really sort of my, I think, the part that really impacted me the most was when I came across How to Make Money in Stocks. And
Yeah.
the moment I read that book, it was, it's very dense. There's a lot of information in it, but I think I inhaled that thing. I like when I would go on business trips, and I had a team in California, and I would fly out there, and on the red eye, everybody is sleeping or watching a movie or drinking, and I'm like going through my trading book, like really trying to nail this down. But it was amazing. And that's, after that point, I was like, now I'm really like, I know I can do this. I'd been
Yeah.
doing very well up to that point, but I was like, this is the piece I was missing.
Mm.
And then, from there on, I became very close to reaching that goal. And I was able to retire in 2013, 10 years after I had set my goal, because at that point I was generating more income from my investments than I
Yeah.
was from my salary as a corporate executive. So it was pretty good.
Vibha, that was a fantastic little mini masterclass on the investing journey. There's so many cool things that you addressed there. You talked about How to Make Money in Stocks, a classic William O'Neil book, really talking about the marriage between fundamental analysis, what the companies do, technical analysis, what the price action is telling you. I think that's a really good way of thinking about it. It's a book that's one of those initial books I recommend to people, just getting started. Really illustrates that very, very well. In my Fidelity days, we would always say, good company doesn't always make a good stock. And
Mhm.
I think that book kind of puts it well. You also, you tapped on the Peter Lynch mentality of, obviously, his approach is, buy what you know, and
Mhm.
sort of, know the products and things like that. You obviously had a bit of a deeper understanding of some of these companies with the ability that you have, but it really has that Peter Lynch kind of thinking of just how to understand a company's business and what the value proposition is. I'm curious, when you think of your formative days as an investor, not with the raging success you've experienced since, but as you're just sort of figuring things out, can you share an example of maybe an early win, like one of those first stories or names where it finally clicked and you're like, this is a good company, this is a good stock, and it worked? And then my follow-up question is, can you give an early example of where things did not go well and kind of how you navigated that first big loss or that first experience where things did not play out how you'd expect?
Mhm. Yeah, so let me start with the early loss
Yeah.
first because those came first. Microsoft,
They often do, right?
which I had mentioned earlier. And again, at that time at work when I bought it, we were using, everything was like the Microsoft platform. We weren't using, the Apple platform. So clearly it was something that was, across so many major companies. I used their product. I knew their product. Once they introduced the Windows, it made things so much more intuitive to use.
Yeah.
But again, I bought it at the wrong time. So, and again, the lesson there was exactly what you just said a few minutes ago, which is it can be a great company, but that doesn't mean it's a great stock at this time, So that was an early loss. In terms of early wins, one of the early wins I remember, it again tied to this Peter Lynch mentality, came from my daughter, because she was 8 or 9 years old at the time, and that year at Christmas time, she and all her friends wanted UGG boots for Christmas, and it was literally like everywhere I looked there were UGG boots, and I thought they were kind of ugly, but everybody was buying them. So I said, all right, let me find out who makes UGG boots, and it was Deckers. And then I started researching the stock. I looked at their fundamentals. I looked at their technicals, and I was like, I think this one looks like it's a good opportunity, and it looks like it's the right time to buy it. And I did. And that one, I think I had like a 40% gain in a couple of quarters, which was pretty big for me, having, lost 80% in the prior companies I had bought. So again, I think it reinforced that they kind of contrast, but they reinforce that it can be a great company, but you have to buy it at the right time.
Right. It's so fascinating. I mean, you really are, you tapped into the Peter Lynch thought process. I mean, he famously took his teenage daughters to the mall back when those were a thing, and would see what stores they liked and what products they wanted, and that was the beginning of his experience, sort of understanding some of these companies. That's fantastic. So tell me this, Viva. At some point along your investing journey, I'm guessing you either gained the confidence or had the success that you felt like the investing championship was something that was a possibility, which you actually entered and had great success with a number of years. Can you talk about, what motivated you? And was there a moment where you're like, oh, this is actually going well enough where I actually could actually have success? Or like, what was that process where you entered into that and then, obviously led to some pretty good results?
Yeah, so it was kind of a longer process, because I wasn't
Yeah.
originally, I didn't even, the US Championship didn't even exist until 5 years ago. But
Yeah.
where it started is when I first started to gain that confidence in trading, I wanted to compare it to a benchmark. So while I was learning, at the same time that I was investing in my individual stocks, I was putting the same amount of money into the S&P 500. And my goal was so this happened after 2008, after the market crash, because I wanted to see like how I want to look at it over a period of time, both ups and downs, and see, is it better for me to just invest in a systematic basis in the S&P 500, or to invest on my own. And I did it for 3 years, and I significantly like I was getting 35 to 40% returns during periods of time when that wasn't happening. Like that had been happening even before, but
Yeah.
this time I was actually comparing myself to the benchmark and doing
Yeah.
significantly better. And so that's what gave me the confidence in 2013 to quit. And then my husband, he would tell everybody about how good I was doing. And then all these people were coming to me saying, can you manage my money? And I said, I can't manage your money. I'm just learning how to manage my own money. And I didn't have a way to say, okay, like, yes, I compared myself to the index, but
Yeah.
like, if I want to compare myself to professionals, what can I do? Because my background was political science and Spanish. I didn't have a degree in investing or finance or anything like that. And then in how to make money in stocks, he had talked about the U.S. Investing Championship. And then in 2019, it reopened.
Yeah.
And so then I thought, this would be a true test, because it's one thing for me to like, compare against, friends that asked or whatever, versus like, these are people who are like, they want this to be their profession.
Yeah.
And at that time, I had also thought that maybe I want to manage money, maybe I want to open my own hedge fund, but I needed a track record that was, like the way, SATs used to be, right? Like you need something that can be compared across, and
Sure.
not just like your own personal interpretation. So in 2019, I didn't enter in 2019. 2020 was the first year I entered, but 2019 is when I said, okay, I kind of dab at the technicals right now or dabble in the technicals, for a 1 year competition, I need to really learn this. And so that's when I joined in 2020. In 2020, I was not that it really matters, but I was the top female performer. I came in number 9, but my return of 155.7% or 155% was, I think, identical to what Mark had when he won the competition. So I was like,
Yeah.
okay, I came in number 9, but let me see if my strategy is sustainable. And that's why I stayed in the competition for a couple of years. A lot of people, the elephant in the room that nobody ever asked me, maybe because they aren't sure how I'll answer, is what happened in 2022. In
Yeah.
2022, I didn't trade because it didn't fit with my approach. So
Yeah.
in November of 2021, when the market was peaking, I raised cash. In early 2022, I took some capital gains because I was locking things in. And then there were different things going on in my family too, but I didn't get back in until the end of 2022. So I sat there. So yes, in my non-investing championship accounts, I did have drawdowns, but the drawdowns were what I expected based on I let my stocks pull back to levels, but it was not a 1 year. I didn't do that in the investing championship. In the investing championship, I said, based on where the market is right now, based on how growth stocks look like they're going to be doing and how TQQQ is doing, I'm not taking, this is my money. I'm not going to like jump in and risk my money for a year if it's not going to work with my trading approach. And so my trading approach was to not trade.
I mean, there's so much maturity to that way of thinking, and that is a realization that so many investors, it takes so long to kind of get to that point where when the conditions aren't right for what you're trying to do, they just try to trade through it anyways, right? It's like if you trade hard enough, you're going to make an opportunity, and what you learn is like if it's not the right setup, it's just not the right setup. I brought up a chart of actually I want to bring up the chart of the S&P just to start with, just to show that year, right? 2022, obviously, the market peaked at the end of 21,
Mhm.
ended up making a major low in October of 2022. When you talk about 2022 not being a great setup for you, is that a bottom up assessment, as in you're just not seeing the right setups or the right configuration in names that you're looking at? Or is it more of a top down, more of a macro perspective of the broad market conditions don't look good, so I don't feel comfortable putting money at risk? Or is it a mix of both, right? What's your way of assessing conditions are favorable or unfavorable for your process?
Yes, it was a mix of both
Okay.
because particularly with TQQQ, it is a market-based ETF, right? It's triple
Yes.
leverage, but it is market-based. So the broader market conditions, they do have an impact. When the Feds are raising interest rates, when we have inflation going on, when all of the different things that had been happening, it definitely signaled that, okay, this is a time to watch what's happening. And then
Hmm.
in addition, the market did peak, at least my stocks peaked in November. So,
Yeah.
and November 2021, I had another, that year I came in number 2 behind Mark Minervini, by the way. So I'll take number 2 behind him anytime. And I had 100% return that year also.
Yeah.
So it was the second year in a row with triple digit returns. And I was trading, IPOs like Affirm, Upstart Holdings. I was trading TQQQ. I was trading a lot of things that were working. But then in November, everything started to like peak. So it was a combination of all of my stuff had been peaking and the macro conditions didn't look too promising.
Yeah.
And then in January, I had a situation happening with a family member. So I knew that I wasn't going to be able to, like really watch the market like a hawk. And so
Yeah.
I thought, I've had a couple of great years of returns. I live off this money. I'm willing to sit back and, wait for what happens.
Patience. What a fantastic quality in an investor, Viva. That's kudos to you. And to your point, we're looking at the TQQQ now. The S&P actually peaked at the end of 2021, right? Actually made a new
Mhm,
high going into year end. The
mhm,
TQQQ actually peaked in November of 21. The
mhm,
QQQ did as well. Great
mhm.
example of where there's that divergence where some of them are peaking and others are not. You mentioned the TQQQ, and I know from looking into you and your work that that leveraged ETF is one that you use often. Can you talk a little bit about your use of leverage, particularly leveraged ETFs like the TQQQ? How do you think about that leverage? Is that something that goes into your thought process of when things look particularly good, I would make a leverage bet? or is that just always the way you play to sort of generate greater returns in the right market environment? How do you think of the leverage part of something like TQQQ?
Mhm. So when I first invested in TQQQ, it was just, like because I wanted to get some leverage, right? It was in
Yeah,
2015. I had a small position. But then over time, as I was reviewing my longer term holdings, my portfolio was full of the FANG stocks at
yeah,
that time. And
yeah,
then what are now the Magnificent Seven, but I had owned them even before. Like I had NVIDIA, I had these others, and they had gotten so big. And I thought, these companies meet my criteria. They're very liquid, but how much bigger can they get? Now, in retrospect, they got a lot bigger, but I didn't know that. So I thought I want to be in these companies, but I want to boost my returns. So then I
mm,
started putting more and more into TQQQ. And then when I entered the US Investing Championship, because of the fact that it's not even just that it's a 1 year competition, it starts in January and it ends December 31st.
yeah,
So you have less time to just sit in cash unless the conditions are bad, obviously, then I sat in cash. But so while I was looking for setups, I would, and the market was doing well, I thought, instead of just sitting in cash, Mike Webster refers to it as a source of funds.
yeah,
Okay, let me like, at least when the market turns, which is when I like to get in, I'm going to get in with a few individual stocks, but I want those stocks to confirm that yes, the market really has turned. But in the meantime, let me put some stuff into TQQQ as well, because it is market based. It's much easier, at least for me. I know a lot of people use QQQ. When you look at TQQQ, it's much easier to see the spikes, the peaks, and the lows. And so I was
sure,
able to train my eye that, okay, we just had a follow through day, but it doesn't look like it's going to hold. I'm getting out, or
yeah,
I'm not going to add any new exposure, and I'll watch what I'm already holding. But it kind of helped me, from that perspective. So yes, I did consider the leverage to help me boost my returns, but I also have looked at it as a way to have a concentrated position in something that is very liquid, because I never had, when I would have concentrated positions in individual stocks, I couldn't hold them as long as I wanted because the drawdowns just became too much at an individual level. And there
yeah.
was too much risk, during earnings time or during other times. So I had to reduce my position size to be able to execute my strategy of holding things for the longer term. But
Right.
I supplemented that with shorter term trading in TQQQ. And shorter term trading is all relative because my shorter term trading can sometimes last for months when it's doing well.
So it's shorter
Like
term in air quotes is what you're saying.
yeah, shorter
Okay.
term, but yes, compared to, stocks I've held for years, yes, it's shorter
It's
term.
it's all relative, right? But I
It's all
appreciate you
relative.
addressing that multiple time frame, right? You hit on a number of things, right? That thinking about different positions that could be longer term, could be shorter term for you, right? Depending on your mandate or on your investment horizon. Thinking about a core position, I always tell people about sort of the core and explore model, having a core position in something that is something that it's at least going to be an understood quantified amount of risk, but then you can
Mhm,
explore and take other speculative positions. And
mhm,
it sounds like you executed that very, very well. Can you tell me a little bit? You mentioned a couple times, right? Sort of the use of technical analysis versus fundamental analysis, kind of macroeconomic themes. You've hit on a number of things. Can you tell us a little bit more about your technical approach? Are there particular techniques, or how would you describe what you look at if you bring up a chart of TQQQ or a particular stock? What are the types of things you use to evaluate sort of the timing aspect of a
mhm.
particular trade?
Mhm. So it's a little bit different for TQQQ
Okay.
versus an individual stock.
Yeah.
So let me start with TQQQ, because for that, the technical indicators I look at really are based on, once the market has pulled back, and my definition of pullback is at least 5% to 8%. In the
Okay.
past, with Investors Business Daily on their market pulse, they used to say market and correction. Now they give ranges, so it's a little bit more of an art or a nuance. But
Mhm.
when it was theoretically, when it would go into market and correction, so 0% exposure, from that point, I would start looking for the first update. The first update would be day one of a rally. And
Yep.
then typically a follow through day would occur on days 4 through 10. So when there was a follow through day for TQQQ, I would get in. Over time, as I started to look for opportunities to maybe get in a little bit earlier. What I saw is that when we had 3 consecutive days of strength after a pullback of that 5 to 8% level, then many times a follow through day was coming. So when I would see 3 days of higher highs, higher lows of strength coming off a bottom, then I would initiate like a very exploratory position. And then when the follow through day happened, then I would go to my position size, or at least half my position size. Sometimes I went to full position size. It kind of depended on what other things I wanted to invest in. And then once I'm in, then at that point, what my stop loss rules were, if it undercuts the low of the follow through day or of that first rally day, then my thesis is wrong. Then I just get out. So that's what I did there. And then once I'm in the position, then I really try to sell on the way up. So then I start looking for, if it's going up and there's no warning signs, there's no sell signals, I just let it go. I let it go up. And then when I start to see, okay, it's been going for some time, but now we have a downside reversal. Now we have a stalling day. Now we're starting to see closes below the shorter term moving averages, which for me are the 10-day and the 21 EMA. 10-day simple, 21 EMA. When I start to see it falling below those levels, then I'm not waiting for the market to pull back into a correction. I'm not waiting for it to touch the 50-day moving average. I'm taking gains and starting to get out.
Right. Vibha, I don't have the ability to give honorary CMT designations to people for professional technical analysts, but if I could, you would be on my list for sure. I mean, that was well articulated in terms of how you do it. Mike Webster and I, by the way, you mentioned at IBD. I mean, just a fantastically nice guy and a knowledgeable investor. We've often compared notes about the 21-day EMA as a really good way to think about, short-term volatility versus, signal versus noise. So I think that's a brilliant way of doing it. And you alluded to what I feel is one of Justin Mamus, famous technical analyst, wrote a number of books on know when to buy, know when to sell, and his quote was, "When a stock doesn't do what you want it to, sell it." Just very simple, right? Here's my thesis. If the thesis doesn't play out, then something else is going on. And the good thing about investing in individual equities is you've got a lot of other charts to look at any point, right? So don't become married to one particular one.
Exactly. And then I'll transition to what I do for individual stocks. But I love that marriage analogy, because when I was on IBD Live, I was joking with them that Bill O'Neil said, he said, date stocks, don't marry them. And I said, but I said, I prefer to move in with them. I don't want to just date them for a short period of time. I want to move in with them, but if it's not working out,
I love it.
I'm going to give them a little bit of room, but in terms of, in terms of individual stocks, my approach is very different, because I'm not trying to pick the bottom or right when the market turns. I'm really looking for a proper chart pattern. And I go with the longer term chart patterns. I know now so many people have very short term things, and you're a CMT, so you know it, but that's not my strength and that's not my personality. So I do look for like the cup with handles. I look for the double bottoms. I look for the flat bases. I look for the traditional bases that Bill O'Neil talked about. However, the difference is that now, because I feel I've gotten more experienced, I don't wait for a breakout. I do wait for it to retake like the 50-day, 10-week, a longer term moving average, and then I'll buy on the way up. So while it's building the right side of the base, if it retakes a key moving average, then I will initiate a position, and generally a smaller size than what I do with TQQQ.
Yeah, very well said. And I'm glad you clarified that there's a difference between sort of your macro position, right, your core position with the TQQQ, and then with individual stocks. And you applied sort of a longer term methodology, starting a little longer term. I think that's really, really well said, Vibha. I'm glad you clarified that. So, I mean, I wish we could keep doing this for another hour, Vibha. Hopefully we can continue this again, but I'd love to just, with the remaining time we have, just talk briefly about the current market environment. You mentioned a previous era where big growthy stocks felt a little extended. One might think you were talking about the current market here in October 2025, because that sounded very familiar as a premise. Talk to me about what you're seeing in the markets now, particularly with a focus on, growth and leverage growth with the TQQQ. How do you feel about the markets here? Is it a time when you feel comfortable taking additional risk, taking some off? Just how are you approaching the markets here in, mid-October 25?
Yes. So I had been selling on the way up since July 31st.
Okay.
So when we had that bad day on October 10th, which impacted a lot of stocks for TQQQ, TQQQ was down 10%.
Yeah.
I did not need to sell any because I was already in 25% cash of my position. And yes, it was a bad day, like the biggest down day in a long time. And it closed below the 21 EMA, but it was just one bad day. And as I said, I look for more than just one bad day or just one good day. So I said, I'm already in 25% cash on this position. I got in at the end of April, so I have a good profit cushion. So I'm going to give it a little bit of room and see what happens. And so I think right now it's actually acting fine. Like, stocks aren't going to go straight up all the way. They're going to have some bad days. I think, right now I'm in a watch and wait because earning season is coming. And
Mhm.
also, I think some of the bad news has been news driven, like whether it was the tariffs or then also interest rates, that wasn't bad, but it's like some of the recent ups and downs have been related to the news cycle. But I think until we get another catalyst, which will either be news or the earnings related news, I think it's going to go sideways. So I'm not adding any more risk, but because I had been raising cash, I am not selling anything right now. And my individual positions that I'm holding, including ones I had bought in April, they're holding their 10-week, their 50-day. Some of them are holding the 21 EMA. So
Yeah.
from that longer term perspective, there's nothing there that's telling me that I need to get out right now.
We're discussing this right in the middle of earnings season, right? Just kind of started last week, and now we're
Mhm,
starting to get some of the growthy stuff reporting this week and next week. Just
mhm.
as one more question, is there something that you do in particular, or a specific approach that you employ during earnings season, or how do you handle earnings, particularly on individual stocks, where obviously there
Mhm.
can be binary outcomes and a lot of
Yes.
volatility? How do you approach this in particular?
Yes. So, in other interviews I've talked about, I have a very streamlined process. I don't spend that much time, but during earnings season, that makes up for it. It's like the 50, 60-hour work weeks. But so I do a lot of preparation before earnings and then also after earnings. Before earnings, I look at everything I'm holding and I decide, okay, as long as I have a profit cushion, is this something that I'm still willing to hold it? And as long as they do what they said they were going to do, then I will hold it through earnings. If I'm holding something and I'm like, I've already had this for a long time, and I look to the left of the chart to see how did it react previously and how much of a potential pullback or increase could there be, and then I decide, okay, if that happens, am I okay with that? If not, I'll either get out or I'll sell some of my position.
Mhm.
After earnings, I go through kind of a similar process of I look at everything I'm holding and I say, do I still want to hold this? If not, I get out. So I spend a lot of time in the front end and then also the back end just to make sure that it's still, because I try to keep a limited number of individual stocks. So
Sure.
they have to really have the potential to not just the potential to be true market leaders, but if I bought them thinking they have the potential, they need to start delivering on that potential for me to keep holding them. But I will give them a few quarters, but beyond that, if they aren't doing what they said they were going to do, then I get out.
Viva, earlier in our conversation, my final question, you alluded to Peter Lynch, and I worked with Peter. He was no longer actively managing money when I was at Fidelity, but he was still an emeritus portfolio manager and would meet with the interns every summer, which they absolutely loved. And one of their favorite times was sitting down with him, and he would just impart timeless investment wisdom. It was this wonderful hour they'd spend with him. If you were meeting with the interns at a firm and giving them one nugget of investment wisdom to get them started, what would you tell them today?
Oh my God. I would tell them just, know yourself and
Mm.
just learn, like be curious, learn, like especially when I wish I could tell my 22-year-old self to like start then, that this is well, I think we have so much amazing opportunity right now that for whether it's an intern or anybody else, there's so much information out there. The common investor has access to so much more than they did many years ago. So just, be curious, learn from what's out there, commit to learning, commit to doing things too, because learning is one thing, but you have to execute also, and start small, start somewhere, start small. And also I would tell them maybe this might not be the best answer for a Fidelity intern, but I would say while you're learning, just start putting some money dollar cost averaging
Mm.
into, a Roth IRA, like use some index-based ETF something so that you're building capital while you learn. Because if you start young and you let it build, like it accumulates much more quickly than you would imagine, even if it's just an index-based ETF. So start right away.
Yeah. For a young investor, that long runway is one of your greatest advantages, I would say. Vibha, you
And
come
Roth IRAs.
great
That's
point.
like a non-negotiable.
Vibha, you came so highly recommended. My friends at IBD, a number of my viewers suggested that I sit down with you. I'm so glad that I did. You're a pleasure to speak to. Congrats on your successes, and I wish you much success going forward. Thanks for spending time with us today.
Thank you so much. It was my pleasure.
I hope you enjoyed that conversation. Vibha is just such a pleasure to speak to, and I feel like there was just so many little nuggets of investing wisdom as we went on. I had trouble keeping up with all the things she was saying that I agreed so deeply with. Just thinking about that conversation, we obviously talked about Peter Lynch a number of times along the way. Just thinking about how to understand companies, right? Going with what you know, thinking about products and services that you understand, learning about them, and then using that as the beginning of an investment process, really thinking about the story. But I think to Vibha's point, and this is what you learn from books like How to Make Money in Stocks, which has a place of honor at the top of our recommended reading list at marketmisbehavior.com. How to Make Money in Stocks talks about how to combine fundamentals, what companies do, with technicals, what the stock does. Good companies don't always make good stocks, but when you can get agreement between interesting themes, stories, the fundamentals of the company and their opportunities to grow earnings, and marry that with strong technical configurations, I think that's fantastic. Boy, that marriage analogy was awesome. I sort of suggested, or we talked about the idea of, not being married to positions, but more dating the positions. And she kind of added a middle ground to that analogy. So what about if we move in together, right? And when you heard her, when she was talking about taking on a new position, sort of implied, I might take an initial speculative position, and then if it still works, I'll add to it and maybe take my complete position. I find a lot of times individual investors sort of think in binary terms way too much, right? I either own 100% of my position or 0%. What Vibha was talking about was taking an initial position, right? Taking a nibble, and if it works, then you can add to it later. And so think of moving in with your stocks before you go full in and get married to them. I love the conversation about follow-through days. Love the conversation about being, courageous to admit when your thesis is wrong and to get out of the way. Using things like the 21-day exponential moving average to, track gains and as an initial sort of trailing stop, just to confirm that the position that you're in is working. Really appreciated her comments about how to navigate earnings season, among other things. I mean, what a great discussion. Thanks again to Vibha Jha joining us today on the show. Really appreciated the conversation. I hope we can have her on again down the road, but I hope you found that as enjoyable as I did. That'll do it for today's episode of the Market Misbehavior podcast. By the way, if you want to learn more about some of the technical tools and techniques that we alluded to, things like the 21-day EMA, how they work, how to use them, and how to manage risk using the best practices of technical analysis, our Market Misbehavior premium memberships may be a great opportunity to upgrade your own decision-making and maybe find some new investing success for yourself. 3 great benefits to the premium membership. Number 1, virtual courses. I'll teach you all about technical analysis, behavioral finance, what's happening between your ears, a practical set of tools called technical analysis to understand the world around you as an investor. Second benefit, you will have all of our premium member reports, like our weekly flight plan, where we talk about what just happened in the week that occurred. We'll look forward at the week to come, talk about particular levels, signals, and patterns that we're watching for. Finally, full and immediate access to our member community. That's where you can learn from other premium members. That's where you can ask questions at any time. That's where I'm sharing random ideas through the course of the week. It's a great place to improve your decision making, to learn from other like-minded investors, and to upgrade your investing game. For more information, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. For Market Misbehavior, I'm Dave Keller. Thanks for joining me here on the podcast. And remember, it's always a good time to own good charts.